Basics of accounting. A businessman comes across various situations which need to be accounted for in monetary terms. For example, Mr. B is the proprietor, that is, owner of the firm, B Positive Enterprises. He is a trader who buys and sells goods with a profit margin. Mr. B has to account for various aspects of accounting. Goods moving in and out of the firm, cash, check deposits, withdrawal from the firm, transportation for goods entering and leaving the firm's premises, traveling expenses, insurance of goods in the godown, payment of salary, receipt of interests on deposits. Thus, in order to keep a complete record of his business transactions, he has to maintain accounts of people and firms he deals with. He has to maintain a record of assets and properties of the firm. He has to keep a record of his expenses and income. Hence, accounts are classified into three categories: personal accounts, real accounts, and nominal accounts. Personal accounts deal with accounts of individuals and firms with which the businessman deals. Impersonal accounts relate to other than persons. These are again divided further into two types. For example, real account and nominal account. The real account deals with accounts of property, assets, and possessions of the firm. Real accounts assume following forms. Tangible real accounts. These accounts consist of assets and properties which can be seen, touched, felt, measured, purchased, and sold. Intangible real accounts. These accounts consist of assets and properties which cannot be seen, touched, or felt, but they are capable of measurement in terms of money. We belong to the tangible family. We belong to the intangible family. Nominal accounts. These accounts do not represent any tangible asset. These are the accounts of expenses or losses and gains or incomes. They exist only in name and cannot be seen or touched. Goods, real account. Salaries, nominal account. SBI, personal account. Printing and stationery, nominal account. Discount, nominal account. Capital, personal account. Loan, personal account. Stock, real account. Investment, real account. Loss of goods by fire, nominal account. Proprietor's wife account, personal account. State government securities, real account. Debentures, real account. Stock of stationery, real account. Outstanding salaries, personal account. repairs to machinery, nominal account. Manager's salary, nominal account. Copyright, real account. Patents, real account. Livestock, real account. Octroi, nominal account. Taxes, nominal account. Audit fees, nominal account. Bad debts, nominal account. Premises, real account. Rules of accounting. Personal account. Debit the receiver, credit the giver. Real account. Debit what comes in, credit what goes out. Nominal account. Debit all expenses and losses, credit all gains and income. Capital. Mr. B introduces 20,000 rupees in cash to commence business. He introduces machinery worth 50,000 rupees in the firm. And he also introduces furniture worth 30,000 rupees in the firm. Total monetary value of everything brought into the business by the proprietor from his outside interest is his capital. Thus, total capital introduced by Mr. B is 20,000 rupees plus 50,000 rupees plus 30,000 rupees, which is equal to 1 lakh rupees. Drawing. Mr. B pays his personal life insurance from the firm's funds amounting to 10,000 rupees. As the amount withdrawn by the proprietor is for his personal use, it is not an expense for the firm. It amounts to withdrawal from his contribution to the firm. Any withdrawal in cash or goods by the proprietor of the firm for his personal use is drawings. Goodwill. How does the firm strengthen its relationship with customers? By probably doing things for customers that they may not even realize. By going an extra mile for them. In turn, what it creates is goodwill. Goodwill is an intangible fixed asset having realizable value. It is the cost of the reputation of a business organization. It is the name established in the market. Books of original entry. In a real-life scenario, the transactions are never recorded directly in the accounts. They are first recorded in the journal or book of original entry. This process is known as journalizing. It is necessary that each journal entry has a source document to authenticate it. Once the process of journalizing is complete, the transactions are then posted to their respective ledger accounts. But as As the business expands and the number of transactions become large, it may become cumbersome to journalize each transaction. Well, there is a better way to post these transactions. As many business transactions are repetitive in nature, they can easily be recorded in special journals, each meant for recording all the transactions of a similar nature. And a few transactions which cannot be recorded in any special journal are recorded in a journal called the journal proper. Voucher. A document which provides evidence of the transactions is called the source document or a voucher, such as sales bill, cash memo, or salary slip. Here is a sample of a transaction voucher. But for petty expenses, there may be no supporting evidence. In such a case, a voucher may be prepared showing the necessary details, and it should be approved by an appropriate authority within the firm. These vouchers must be preserved in any case till the audit of the accounts and tax assessments for the relevant period are completed. Thus, each and every business transaction needs to be recorded in monetary terms. This is done keeping in mind basic accounting rules. Each transaction needs to be supported by a voucher. Transactions are then recorded in a number of books, namely journal proper, cash book, other day books such as purchase book, sales book, purchase returns book, sale returns book, bills receivable book, bills payable book. Based on these books, final accounts of the firm are prepared.